How to build a successful Amazon aggregator when the industry attracts $13.5 billion of capital. Amazon aggregators are booming. Aggregators, also called Amazon Roll UPS, by third-party sellers operating on Amazon. The idea is to buy up successful sellers, scale them up, and maintain them under one parent company. A strategy similar to that of conglomerates like PG or Unilever. There are about 89 active Amazon aggregators competing to identify and buy popular Amazon brands selling everything from weighted blankets to beauty products. The most attractive acquisition targets rely on Amazon's infrastructure to store, process, and ship out their products, a service known as Fulfilled by Amazon. Roll UPS have collectively raised $13.5 billion since March 2020, according to Marketplace Pulse. It's a gold rush, but not everyone will get rich. The Chicago debt provider Victory Park Capital has 9 aggregators in its portfolio and has reviewed over 125 similar businesses. It's definitely harder to do at scale than people appreciate, Tom Welch, a partner at the firm, told Insider. It's not as simple as buying a successful Amazon seller, raising prices to increase margins, and expecting profit. Roll UPS need to think about operational improvements, too. It's hard and it's complicated, Welch said. The US firm THRASIO, one of the biggest and best-known aggregators, was founded in 2018 and is sometimes regarded as the first roll-up. It was actually just the first to get it right at scale, Welch has previously said. Most aggregators are privately held and don't disclose numbers, but some publicly available figures are indicative of the profits and margins operators are chasing. One retail group in the UK has been quietly acquiring third-party sellers since 2013 and is entirely self-funded. A unique position, a company spokesperson told Insider. The firm posted a 47% increase in turnover to $557.5 million for full year 2020, a profit of $557.5 million, and a 29% profit margin, according to financial filings. But Welch has previously suggested the sector's explosive growth will slow down. The biggest, and probably earliest, misconception is that Amazon brands are low-touch or set it and forget it, Welch said. Whether it's detergent or beer, brands have a natural decay, he added. Aggregators need to reinvigorate the products, launch products, and take care of listing pages, he said. They need to think about ad spend, supply chain disruption, and costs, all of which require money. Successful aggregator will also acknowledge the industry's risks, including its reliance on Amazon as a selling platform, which could hike fees or change its algorithm at any point. Welch said, founders should know how they will mitigate these risks, how the team will be built, and which category they will target. We don't want folks to try to fund everything with debt, Welch added. We want there to be an adequate amount of equity funding the business so it's a healthy balance sheet. A great team is also a factor, with several of the highest profile aggregators run by ex-Amazon execs or sellers. Perch, a firm founded in 2019, recently poached Christiana Helmick, Amazon's former director of consumer, and made her its chief revenue officer. London Solsam was founded by Ali and Sam H02 BYE, brothers and former Amazon sellers, while THRASIO's European-led Jim Mann joined the company after a career as a third-party seller came to an abrupt halt because of the pandemic. Build out and hire a talented team as early in the process as possible, Welch said. At the end of the day, all comes down to WHOS managing and operating these